So the video is about market sell-off. So let's see how the market has reacted after the scams or else after the crises which have happened in the past. So just let's look at the historic return of the Sensex. So this is the data from 1986 and we have calculated the rolling returns on a 1 year, 2 year, 3 year. So this one is up to 40 years, right? So if we look at the minimum returns and the maximum returns, and obviously from 1986 onwards, hit a 40-year return, almost pretty much everything is at a similar range. So the difference between the low minimum and the maximum return is 13.26%. So irrespective of crisis and scams, what you have to understand is for any equity investment to perform, you should have the long-term horizons. That's the first thing you have to take a note of when any investor is investing. But again, we do not have the 1980s kind of conditions now. So maybe the return profile will be slightly different. But again, even now when you are calculating the last 10 or 15 years, uh, so anything less than 5 years is something which you should not even invest. So what happened during the Harshad Mehta scam? This has happened in 1992. So if you look at it, it's around March is something, March 1993. So the returns are like negative 27, 35, 42. So somebody invested in March were having negative 50% return. So okay, the minimum return 1 year horizon would be around 53.35%, but this is more during the global financial crisis. But even if somebody has invested during the Sarshad Mehta scam and had they stayed put for, you know, over 20 years, 25, 30 years, if you look at it, it's around 10.86%. This is the median return. So this is the minimum and the maximum. So pretty much even at 9%, this is very attractive return if you look at it. So people stop valuing 9%, 10%, 11, 12% because of the rally which has happened post-COVID. So, but 9% is actually a very good return. So let's look at what has happened after dot-com bubble. So if you are somebody who has invested in 2000 and just have you waited out, right? Again, these are all rolling returns. So on a 25-year basis, again, if you look at the minimum and the maximum return, right, the differential is around 0.8 percentage points, right? And the other thing you can notice is as the time is passing, as the country is developing, the market is becoming more and more resilient as well. So initially from 1986, if you look at it, it took 40 years for the differential to be around 0.2%. So after 2000, it is like 25 years time where the difference is around 0.6%. That means irrespective of the market highs or lows, if somebody has invested, so the return would have fluctuated anywhere between 10.72 to 11.5%. So now let's look at the global financial crisis data. So had you invested in 2007, the crisis has happened in 2008. So from 2007 to 2025, if we are looking at it again in a 15-year horizon, the minimum return is at 7.31%, right? Again, at any point of time, if you are investing, this is a median, it is around 10.5%, right? So ideally, the medians are the ones you have to look at it. But even if you are looking at the minimum 15-year return, right, after the global financial crisis compared to the Sensex, when you are comparing from 1986 data, the minimum return is 5.1%. That is, again, there is an up move, right? So the markets, as we are, as I told you, like as we are moving across the timelines, it is becoming more and more resilient. Now let's just look at the COVID returns, right? If somebody has invested on 1st January 2020 and just stayed put, their minimum return would have been, or else if they are contributing, the minimum return for that person would have been after 5 years, 12.77%, right? The maximum is high, but that's how it is because somebody would have captured something at a very low price. Median is at 13.66%. Again, the time horizons is all that matters. So now if you look at it, so if you are someone with the right set of asset allocation, and if you are somebody who can stay put in such markets, you know then you will be doing good. The reason is you will have the time horizon for the equity to work its magic. If somebody is there who doesn't have the time horizon and he or she is just putting in the money, then that person may end up losing the money, right? Like as Warren Buffett has told, market is a place where wealth transfers from impatient to the patient, right? And at the same time, if you are somebody with a leveraged positions, then again it's a challenge, right? But if you look at the economy, if you look at these crises, right? So these are all structural, right? Harshad Mehta scam. The banks did not have right systems in place. Somebody could create a scam. Dot-com bubble. The valuations have been excessive. Even something like a pets.com was quoting a 1000x price to earning at that point of time. Global financial crisis. Again, this is structural. COVID. Even this was structural. The global supply chain and everything. So, uh, but as today's market sell-off, it was not structural. It was just a policy change. We don't know how it happens and how it pans out, right? So will the industry be okay shifting the supply chain to the US, all the manufacturing? Because we don't know what happens after 3.5 to 4 years time, right? Because Trump's tenure is also for 4 years. So, and again, if you look at the 1 year, 2 year, and 3, 5, 7 years returns, so compared to the older, if somebody is invested in 1986, the volatility will be slightly lower, right? And at the same time, the market is coming back in a very fast pace, right? The 1 year minimum return, if somebody has invested, would have been like around negative 6.11%. This is after 2020, right? So, and even 2 years return, it is positive. That's not the case elsewhere. So this is because the markets have become more resilient in India. And of course, there have been a lot of structural changes, right? But if you are somebody who are in the 25 to 30 or 35 years of age with 20, 25 years of horizon and right asset allocation, right? You will end up, if you have already invested, it would be wise to stay put. Just you have to endure this pain. That way you will end up getting some good results after 20, 25 years because you have that horizons in place. At the same time, somebody with the leverages and somebody who doesn't have a right asset allocation, probably you should rethink your investments. And it's always better not to leverage and invest. It's always good only you invest whatever is surplus and if you are having a long time horizons, right? And so this video is intended for an educational purpose only. The asset class in discussion is neither an recommendation to buy nor sell, right? Even before investing, it is always prudent that you check your financial goals and asset class and whether they are in line, right? Only then you have to invest in the equity markets. In case you do not have time to do that, you please go to a financial advisor or a distributor who can help you with the asset allocation and the goal planning or a financial planning. Thank you.